So good day from everywhere you might be listening to me today. Please, if you can,
Good afternoon, sir.
okay, thank you so much. I'm sure you can hear me. Just a thumbs up
Good
sign.
afternoon, sir.
So we have to delay a bit so that we can have quite a number of persons joining us. You're pretty welcome. I'm sure you have been studying. Your exam is fast approaching, and it is important for you to write your FR this diet. And I'm certain with for all that we have covered so far, you should be by now 40% ready to write your exam. If not 50%, you should be fully ready. I mean, 50%, let me put it that way, not 40, 50% ready to write your exams. If you have not start preparing, please start preparing. So today we mirror down and look at another standard, and that's talking about IS 12 income taxes. It is also one of the standard I will tell you for free. It's as simple as ABC, very simple as it were. It's not something that is difficult. And then the essence of this standard is for us able to reconcile exactly what we should recognize in our books as our income taxes. We know that taxes are compulsory levies from the government on anyone that is trading, carrying out, or carrying on any business, as it were, in the country where you reside. For instance, in Nigeria, we have taxes that is being expected by the government because that is what they use in running the government. So also as an entity, if you are carrying on business in Nigeria, as it were, it is expected that you should pay your taxes as well. Any of the country where you are residing across the world, I'm sure there are quite a number of countries. I think few countries that are maybe not charging taxes, or maybe they have a very low rate, as it were. But taxes are government levies on your profits as long as you are carrying out a business trading, as it were. So how do you account for these taxes? And that is why we are here and to look at this standard. And then, like I always discuss in my first class, just imagine yourself as an entity or an accountant, or the one responsible for the preparation and presentation of financial statements. And in your books, you have a profit for the current year, 10 million naira. And then the tax authority said, no, the profit that you have, the taxable profit, that is the profit that can be taxed, is actually 8 million naira. The question is, which one will you record in your book as the profit that you are going to tax? And this is where, ISF actually come in to explain the gaps, how exactly we are going to record it, what should you record in the current year, what should you carry forward, and the likes. And that's what we are looking at today. So now these gaps between both the accounting profit and what we call the taxable profit will actually give rise to two concepts in terms of what you should record in your book. It will give rise to what we call the current year tax and then the deferred tax. So IS 12 actually deals with these basic two taxes, current year tax and then the deferred taxes. And so the current year tax is a concept on its own that has how you should deal with it. And then the deferred tax also is a concept on its own that has, that have how you should deal with it. But all of them put together, you should understand that what we're simply saying is you, as an entity, you're an accountant, you have prepared your book, you have arrived at a profit, and that profit, when of course, a lot of us were familiar with the financial statement of that this is the term of profit or loss. You have what we call the profit before tax. You have arrived at that. Expectedly, you have to just charge your tax based on the rate that is prevalent, and then you have what we call profit after tax, and that's what we call the accounting profit, as it were. Equally, we have the tax authority who will tell you, they will assess what you have done, your books, as it were, what you have prepared, and they will tell you at the end of the day, no, the profit you are telling us that you have made is actually not correct, or it is correct. That is exactly what has been happening over the years in the professional world where we have found ourselves. So let's quickly go to this concept that this conflict always arrived at, that is the current year tax and then a deferred tax. What is the current year tax? The current year tax is a tax that is expected that you should pay on your trading activity within a financial year. In other words, you have made income all through the year. You have as well incurred expenses. When you net it off, you should have what we call profit before tax. And that profit, as an accountant, you should tax it as it were. But then, like I've explained earlier, the tax authority may say, no, what you have actually put down as your, as your profit before tax, as it were, may not be correct. And so that is what will also give rise to the second concept known as the deferred tax. So the current year tax are actually what I call what we have prepared in line with IFRS. That is our principles as guided by IFRS, what we have prepared as an accountant, and then we have charged our taxes on it. And then the deferred tax, more or less, is the preparation or your books that have been prepared, that has been re-prepared by the FIRS, now that is the tax authority, and then they are telling us that this is actually the state of your affairs, as it were, and this is what your charges are. Yeah, this is the profit that you should charge your taxes on. So now understand this. The simple thing I'm trying to explain is this: you have the tax that is computed by an entity, and you have tax that is computed by the tax authority. The tax that is computed by an entity, you charge your tax on it, you charge the tax rate on it. That is what you are expected to pay in the current year tax. Now, the deferred tax will always arise as a result of the differences that may emanate between what you have prepared in line with IFRS and what Federal Inland Revenue Service, that is the tax authority in Nigeria, has prepared in line with the laws of the land. So once there is this difference, that is what we refer to as temporary difference. When there is this difference, it will give rise to deferred tax. In other words, just as the name sounds, deferred, meaning deferred, you are stopping it, you are stocking it for the future. Meaning deferred, you are allowing it for the future. That is, either you pay it or you recover it in the future. That's why they call it deferred tax. It's just as the name sounds. The current year taxes, you have prepared your book, you are charging the rate on the tax, your profit before tax, as it were. And then the deferred tax is the tax authority, they have also prepared their own. But then there are differences between what you have prepared and what the tax authority have prepared. And that will give rise to future reconciliation and future payment or recovery, as it were. It's as simple as that. Do we understand? So let's quickly run through current year tax, what you have to pay now, deferred tax, what you will pay or claim later because of differences. That's why I call it deferred tax. That is the differences that will occur now between what we have prepared, the tax authority have prepared, and what you as an entity have also prepared. It's a simple idea. So the key idea is this: you should be able to recognize taxes on your expenses as well as on your income and your expenses in the period that's related to that income and expenses or in your financial statement. In other words, whatever it is that you are prepared, whatever it is that it's your income and expenditure for the current year, you should be able to actually recognize it in your financial statement. In other words, you don't need to carry taxes for the year and take it to the next year, as it were. You should be able to calculate the tax that is due for this current year, recognize it in your books, and that is the essence of this standard, as it were. So there are key definitions. What are accounting profits? Accounting profit, just as it stands, profit before tax, that is as per IFRS financial statements. That is tax calculation that is based on IFRS principles. That is, I've explained that over and again. The one that you used to prepare. We as professional accountants, what we used to prepare for our entity that we work for, or that we are engaged in, maybe if a consultant, as it were, you prepare your profit or loss account at the end of the day, or the profit you arrive at, you charge your tax on it as it were. And then we also have what we call the taxable profit. That is the profit on which the tax authority calculates your income tax. That is based on the laws of the land. I call it tax calculation based on Federal Inland Revenue Service. So what I used to tell my students is this: accounting profit is IFRS tax calculation. Taxable profit is FIRS tax calculation. Did you see it now? One is IFRS, the other one is FIRS. So don't get yourself confused. That is just that for that. So current year tax also have is an approach by which we should be able to calculate it. Now I've been saying that is your profit before tax, and then you take your what is it called, your tax rate on that profit tax, as it were. But be that as it may, you should understand that you are operating in a country. I will mirror everything we are discussing down to, I will mirror it down to Nigeria as a country. In Nigeria as a country, we have what we call tax depreciation, which is also known as a capital allowance. That is, for any qualifying asset that you have in your business, you are allowed, some reliefs on it. You are allowed some percentages of reliefs on it. And that is what we call taxable depreciation. In fact, this taxable depreciation is what is always bringing the conflicts between usually forms, let me say, 60 or 70% of what we always call the differences between what we as an accountant of an entity will prepare and what the tax authority will also prepare, because tax depreciation is always different from our accounting depreciation. Is always different, and that is what will always give rise or bring about what we call a temporary difference, and that is what will always give rise to deferred tax. Before I move forward, let me just recap for some of us that are still joining. We are looking at income taxes, and I said income taxes, they are compulsory levy. Taxes are compulsory levy that you pay to the government because you are doing a business within a country of jurisdiction. For instance, in Nigeria, you are carrying out business, it is a levy you pay. And then the income tax is what you are expected to pay to the government through the tax authority, as it were. So that is that for that. And I'm not saying that these income taxes, when you are doing the calculation, it can give rise to two key concepts. And that concept is the current year tax and the deferred tax. The current year tax and the deferred tax. The current year tax is the tax that you pay based on following the IFRS principles. The tax that you will pay at the end of the day following the IFRS principles. And that is talking about what you prepare in your statement of profit or loss for the year, where you arrive at profit before tax, and then you charge your tax rate on it. And then the deferred tax, as it were, will arise as a result of the tax authority also preparing their own account based on the information you also provided, and then they look at what is applicable according to the tax law of the land, and then they arrive at their own calculation. And now this calculation will always give rise, to what we call a difference. That is temporary difference. It can be temporary, it can be permanent, but usually it will always arrive at a difference. And that difference will warrant that either you as an entity will pay additional tax, or you claim an additional tax. And that payment, or in the future, as well as claim that you can have in the future, is what we call deferred tax. I hope that is clear enough now. Are we good to go? Can we ride on? Any question? Okay, Michael, go ahead. Michael, I can't hear you. I can't hear you. It's making noise.
Let me just take a picture.
Okay. So that is that for that. Now, okay, go ahead.
Good afternoon, sir.
Good afternoon.
Please, I don't know if you can explain the temporary difference and the permanent difference again.
Okay. I wanted to take that to later time in the class, but since you have asked now, or wait, let me just explain this deferred tax again so that some people will just have the best understanding. I believe from there we can pick it up. So, deferred tax, they are what, like I've explained, you have prepared your account, and then they have prepared their account. Tax authority have, on the account you prepare, they do what we call assessment, and then they evaluate it, and then they come about and tell us that, look, what you have calculated is not correct. And so that's what we call the tax base. They come out to tell us that this is your tax base, and then you have your own accounting base. So the differences between the accounting base and then the tax base will always warrant to either you as an entity, you are going to pay more taxes, or you are going to claim more taxes. Do you understand now? So the differences between the two is all will result to you paying either more or claiming either more. And so that paying more or claiming more is what we refer to as a deferred tax. So deferred tax, they are more or less like the payment that you are to, the more payment you are to make in the future, or the claim you are to recover in the future as a result of the differences in the calculations, in the calculation of an entity and the tax authority. It's as simple as that. I don't want to use so many nomenclature. It's as simple as just get it this simple way. The differences between what an entity has prepared in line with IFRS and what the tax authority has prepared in line with tax law. And these we are give rise to either you as an entity paying more, or you are going to claim more taxes from the entity, from the tax authority. So like that is just simple as it is. So now understand this, that this deferred tax, like I said, can give rise to temporary differences. Now, what is these temporary differences? Now, the deferred tax uses this approach because they use what we call the asset approach. Why? Because it is majorly the asset that affects, you know, the the that give rise rather to the differences that will always occur between what an entity have prepared and what the tax authority have prepared. And why is this so? For instance, under the tax law now, depreciation, accounting depreciation is not allowed under the tax law. Whereas as an accountant, you are expected to, in line with IFRS principles and standard, we are expected to depreciate our asset over the useful life of the asset as long as we can identify it. You understand now? Now, in you uh, cropping or crafting the useful life of an asset, you use what we call estimate. That is, you are estimating the life of an asset. How sure are you that a car that you bought today is going to use 4 years or 5 years, as it were? How sure are you? No, that's what we call estimation. You are estimating the useful life of the asset, which is prone to error. So tax authority, they don't believe in that estimation. And so rather what they do is, so also to, ease business and affect businesses, a tax law and a tax authority that affect those tax law, there is what we call allowances there. They give you allowances as a form of relief to also aid your business. So you use accounting depreciation to determine your profit, the tax authority will not look at it that way. Rather, they will tell us that we should use a capital allowance, which is a relief in your business. So that what is it called now? That tax authority calculation will give rise to what we call the tax base. will give rise to what we call the tax base. And whereas the calculation of the accountant, as it were, or following the IFRS principle, will give rise to what we call the accounting base, as it were. So I was explaining that in arriving at these temporary differences, we use what we call the assets. And so assets, when you follow through the assets, at the end of the day, as an accountant, you use what we call accounting depreciation. And you know that your cost minus accumulated depreciation will give rise to what we call the carrying amount of an asset. That is to you as an accountant following the IFRS principle. But now, following the tax law, as it were, the tax man or the tax authority too, they will prepare their own. They will say, no, it is cost minus tax depreciation, which is also known as a capital allowance. I want to be using the word interchangeably. Tax depreciation is the same thing as a capital allowance. Please note that. I want to be using it interchangeably in case they use anyone for you in your exam. So cost minus tax depreciation or capital allowance will give rise to what we call the tax base. Tax base. That is the carrying amount according to the tax authority. Whereas as an entity, the your cost minus accumulated depreciation will give rise to what we call the carrying amount according to we the accountant following the IFRS principle. Whereas according to the tax authority, your cost minus tax depreciation or capital allowance will give rise to what we call the tax base. So now the difference between the carrying amount of an accountant that follow the IFRS principle and that of the taxman that follow the tax law, will give rise to what we call the temporary differences. That temporary differences simply means that we can reconcile it, and then you as an entity will pay if there is an excess for you to pay, or you as an entity will claim if there is additional for you to pay, and you as an entity will have a claim if there is an excess for you to claim. Is that understood? Let me use a case scenario now. Let's assume that Michael is an accountant for me. The name of our company is ICANN PLC. Then what is her name now? Keta. I said you should teach me how to pronounce this your name. K. Let's just use K. K is the tax man. Now, Michael have prepared for me as an entity. He has prepared for me my financial year. He has prepared for me the current amount of my asset for this current year. In terms of, let's assume my PPE now. He has prepared everything. The cost is 10. The depreciation is 2. And at the end of the day, I have 8 as my carrying amount. Then K2, being a tax person, said, okay, you have prepared your own. Fine. Remember, the carrying amount is 8. The taxman is now saying, look, no, let's look at what the law have said. The law said depreciation, the capital allowance that you can have is 1. And then the cost of the asset, remember, is 10. So the cost of the asset is 10. The tax allowance or the tax depreciation, as it were, is 1. So 10 minus 1 will give me what we call 9 at the end of the day, which is known as the tax base. Remember, Michael have prepared 1. It has 8. Is that also using accounting depreciation? And then K has also prepared for the tax authority. And then what they had at the end of the day was 9 as the tax base. So the differences between 8 and 9, you can see, is 1. And this one is reconcilable. That's why we call it a temporary difference. You understand me now? The main thing that you need to understand here is this. This temporary difference, how will it be reconciled? Is that also? And that will take us to the next level. But before we go to that next level, do you understand what I have explained so far? Do you understand? Is it clear enough? Can I go ahead? If you don't understand, please bring me back. Okay. Can I go ahead? Just give me an emoji thumbs up so I can go ahead. Okay. Thank you. Thank you. Tolani Esther, you are raising your hand. Ask your question. Oluwakemi is like you're also raising your hand. Any question? Okay, thank you. So now, How do you reconcile this temporary difference? Or before I move further, there can also be what we call a permanent difference. Temporary difference means you can reconcile it. Permanent difference means you cannot reconcile it. It's as simple as that. Just take it the way I've mentioned it. For the person that asked me difference between temporary difference and the permanent difference. Temporary difference means you can reconcile it in terms of we will look at our book. Okay, you are paying us, you pay. Okay, you have looked at our book, you are claiming, you claim. That's temporary difference. Permanent difference is that is you have it is permanent, it is unreconcilable and the likes. You understand now? So that is that for that. So now the next thing that we need to understand is this. Every temporary difference will give rise to what we call deferred tax. And this deferred tax can either be a deferred tax asset or a deferred tax liability. Please take note of what I've just said. The deferred taxes will give rise to deferred tax asset and deferred tax liability. And deferred tax asset is the tax difference that you can claim. Please just take note of what I've just said. Deferred tax asset, they are the differences that you can claim as an entity. It's as simple as that. Whereas deferred tax liability, they are the tax that you are to pay in the future arising from the temporary difference. Do you understand what I've just said now? I don't want to use nomenclature for you. Just this layman where I'm saying it, just be grabbing it. Deferred tax asset, they are the taxes that you can claim from every temporary differences. Whereas deferred tax liability, they are the deferred tax that you are to pay as a result of temporary differences. Please take note of what I have just said now. Now, how will you know which one is deferred tax and which one is deferred tax? Deferred tax asset and deferred tax liability. How do you account for it? You understand? I want to just do all of this summary, then we go to calculation. So we have, how do you identify deferred tax liability? Now, it's very simple. I told you that deferred tax is when you compare the current amount of an asset or liability with the tax base of an asset or the liability. So now, when the tax base of an asset is higher, when the tax base of an asset is higher than the current amount of an asset, it will result to what we call deferred tax assets. Let me take that again. When the current amount of an asset is higher than the current amount of an asset, it will result to what we call deferred tax asset. Please take note of what I have just said. If, for instance, the example we look at the other time, the accounting current amount, that is the current amount of the asset, was 8. Then the tax base of that same asset was 9. In this instance now, it means that the tax base of the asset is higher or greater than the current amount of the asset. This will result into what? Who can tell me?
Tax liability. Deferred tax liability.
Jesus Christ is Lord.
Deferred tax assets. Deferred tax assets.
Any contrary opinion? Let me state that example.
Reconcilable difference.
Let me state it again. When the tax base of an asset when the taxes of an asset is higher than the carrying amount of the asset, it will result into deferred tax assets. Then, when the tax base of an asset is lower than the carrying amount of an asset, it will result into deferred tax liability. That is on asset now. When you also have liability, where the tax base of the liability is higher than the carrying amount of the liability, it will result to deferred tax liability. Maybe I should just write this down for us to understand this thing very well. So where you see that for assets, let's write it for assets. Please take note for assets. Please mute your mic. Where the tax base greater, please mute your mic, greater than the current amount of the asset, this will be equals to, this will result to deferred tax assets. But where the tax base greater than the current amount of the asset, it will result to what? Deferred tax liability. For liability now, for liability,
Please check your second line. Where the tax base is greater than carrying amount.
When the tax base is greater.
Can we mute our mic? Please mute your mic. I will remove you from the class. So where the tax base is greater than the current amount of the liability, this will result to deferred tax liability. And where the tax base is lower than the current amount of the liability, this will result into deferred tax assets. Is that taken? Please, this is where the major work is.
There's no conductors. They don't eat yesterday. It's not here. Oh.
Okay. Lily Bete, please ask your questions. Lily, you raise your hand, please ask your question. Okay, put down your hands if you have answered your question. Thank you. So please, this is what you should know. You see, this one, and how to arrive at, how to calculate the current year tax. This is where the basic thing is, please. So we'll do some just simple example before we take other bigger example. And then I believe with that you will understand it. But understand what I'm saying so far. Where the tax base of an asset is greater than the carrying amount of the asset, it will result to deferred tax asset. That is, you can claim that tax in the future, not in this current year. You understand? But you can claim it in the subsequent financial year. But when your tax base is lower than the carrying amount of the asset, it means that you are to pay the tax authority. It's as simple as that. So now let's look at this way. The carrying amount of an asset of PPE is 10. Then the tax base is 12. What will this result into? Who can quickly help me? What will it result to? Are we still together?
Deferred tax asset of 2.
2. Why? Because the tax base is greater than the carrying amount. So if it is vice versa, what will it give to us? Let's assume the carrying amount is 12, the tax base is 10. What will it result to?
Deferred tax liability of 2.
Deferred tax liability of 2. Now let's assume this is a liability that we are looking at. The tax base is 10. The tax base is 12. The carrying amount is 10. What will it result to?
Deferred tax asset of 2.
Come again.
It will be deferred tax asset of 2.
Are you sure? Let's assume this is liability now.
Tax liability.
Look at
Tax
it now.
liability.
The carrying amount is 10. The tax base is 12 for liability.
It's deferred tax liability.
It's liability. I thought that it's taxes you are referring to. It's liability.
Thank you so much. Deferred tax liability. I'm sure we all understood it now. And that is very simple how to deal with this deferred tax asset. So now, let's quickly go back to our current year taxes. You have understood the basics now. Let's look at how do we calculate our current year taxes. We look at how we calculate the current year taxes, as well as take illustration on the deferred tax asset and liability computation. And then with that, I believe we are good to go. So now, what are the step-by-step approach in determining the current year taxes? It's as simple as this. Number one is you are going to always start with your accounting profit for the year in the financial statement. That is profit before tax. And there, you adjust for all the non-taxable and all the non-deductibles. That is, you add back all the expenses that are not allowed by tax. And then you deduct all the income that are not taxable. And this will give us what we call the taxable profit before tax. So let me say this before we continue, that your current year tax is equals to your taxable profit multiplied by your tax rates. Also, the accounting profit before tax is different from the taxable profit, that is, the one that tax authority recognize. And these two also can also give rise to temporary differences. But in order for you not to, not to disturb yourself much, just mirror it down. According to this standard that we are looking at now, what we are focusing on at your level now is the temporary difference that has to do with majorly assets, both current and non-current assets, as well as a liability, current liability and non-current liability. But for the profit, just leave that one for now. But understand that what is expected of you in determining the current year price is your taxable profit multiplied by the tax rate. How do you arrive at the taxable profit? It is very simple. It is you first of all identify your profit before tax, then adjust for all the non-taxable items like your depreciation, the fines, the penalties, all of those ones, they are not allowed according to the tax law. You add them back to your profit before tax. Then you deduct what we call the non-allowed income, like for instance, your all this dividend that you paid, government grant, tax exempt income like dividend. Dividend, you are not to tax dividend, and maybe dividend that you receive from other subsidiaries as it were now, and it's part of your income. It is not taxable. You don't tax it. Then government grant, you don't tax it. So all of these ones, you also deduct them from your profit before tax, and then you arrive at what we call tax profit before capital allowance. And if you are able to arrive at that, you less the capital allowance that is given to you. And then when you less your capital allowance, another relief, what you arrive at is what we call the taxable profit. It's as simple as that. Now, understand that in a question, they may give you accounting depreciation and tax depreciation. If they give you both, you are allowed to net it off. You are allowed to, take accounting depreciation from the tax depreciation, and whatever is the balance, you just either you add it or you less it. Now, when the tax depreciation is higher than the accounting depreciation, that is when you will less. But when the accounting depreciation is higher than the tax depreciation, that is the capital allowance, that is when you are going to add. Let me come again. Or let me just use a simple format for you so you don't bother yourself much. Once you have your profit before tax, add back all the non-allowable expenses, which include depreciation. Deduct the income that are not taxable, like dividend, government grant, and then you arrive at what we call taxable profit before capital allowance. Then you deduct your capital allowance from it. It's as simple as that. I wanted to do a direct way before, but I think that will be confusing a lot of us. And once you arrive at your taxable profit, the next thing you do is to multiply it by
Tax rate.
the tax rates. And then you arrive at the current year tax. It's as simple as that. And then the accounting treatment is you. Okay, somebody want to ask a question? Please mute your mic. Officer, go ahead.
Yes, sir. Is there any way you can
Why?
mute everybody's mic? There are a lot of interferences.
Okay. Thank you. We'll look at that. But I'm sure everybody has muted their mic now. So now, that is that for that. It's as simple as that. So your taxable profit, your current year tax is equals to your taxable profit multiplied by the tax rate. Very, very simple. Look at it here. Add back depreciation, non-deductible, like that, and then you arrive at it. Like I said, the journal entry, very simple. Just the usual way. Debit your income tax expense, that is debit POL. Credit your current liability with tax payable. Debit POL with income tax expense for the year. Credit your statement of profit or loss under current liability with tax payable. Now let's look at this example. Akan will suffer limited has the following information for you as the CFO. Profit before tax 5 million. Book depreciation that is included in profit before tax is 600,000. There is no tax allowance for this current year, meaning there is no tax depreciation. And you have what we call the non-deductible entertainment, meaning the non-deductible entertainment, that this is not tax allowed. Doubtful debt the provisions, it is not tax allowed. And then you have the tax rate. It's required that you should determine the current year taxes. Remember what I told you? I said that your current year tax is equal to what? Who can tell me again as a recap? Your current year tax is what?
Okay, so you said
Taxable
profit times tax
Taxable
rate.
profit times the okay.
Taxable profit times the tax rate. That is it, as simple as that. So you have to determine your taxable profit in this question. So that takes us to the solution. Solution. I'm sure this is very simple. Please understand that generally, even if they did not tell you there are some expenses are not tax allowed, you should know them by now. For instance, provisions, any provision, they are not allowed according to the tax law. Very, very simple. Please note that. Oh my God. The the depreciation, they are not allowed. And all these penalties, entertainment, you do meeting, you do entertainment, they don't recognize it. A lot of them like that. Please take note of that. So this one now, how do we arrive at our taxable profit? This, oh my God. How do we arrive at our tax rate? Very, very simple. The profit for the year is 5 million. Profit for the year is 5 million. So our taxable profit will be equal to profit before tax. This, what is our profit before tax? Give me the figure.
5 million.
5 million.
Okay, 5. Then we say we add back all non-allowed, right?
Yes, sir.
Add non-allowable expenses. That is, we have depreciation. How much is that? What's our depreciation? That's 600. Entertainment
600,000.
Okay. That's 0.6. Then we have entertainment.
0.1.
Okay, what are that in again? Provision. How much is it? Are we see together? That's 150. That's 0.15. Please add it together. What do you have? 5.85.
Yes, 0.85.
I'm doing this now to make it simple, and that's how simple it is. For those that are, just joining, they don't know how this thing is being done. That is how it is. So it's as simple as this. This is how to arrive at it. And there you have your taxable profit to be
4.15.
Thank you.
4.15.
You are going to hard now. You are not going to less, bros.
Sorry, sir. 5.85.
5.85.
Thank you.
5.85.
5.85. Please don't make mistake. Oh, this thing that my brother have just done now. It used to happen very well in the exam. Oh, you will now say, well, I deal with icon now. How come I'm coming back? Instead of you to hard back, you are removing. Please, just take your time. Don't overrush. Just check again. Be sure of your
Thank you,
decision.
sir.
So, our target profit is 5.85. Therefore, our current year tax,
30%.
Thank you. Our current year tax will now be equals to 5.85 multiplied by, what is our percentage? 30%. 0.30, and that will be equals to what? Are we together?
1.755.
1.755.
1.755.
Thank you. 1.755. This is our tax rate for the year. Please take note. It's as simple as this. Thank you. Now let's look at this example again. This one has a tax allowance. Now, alright, so good day everyone from everywhere you are hearing me. Please, if you can hear me, just give me a thumbs up emoji so we can continue. Can you hear me, please? Can you all hear me? Alright, please, we don't have much of the time to waste tonight. We just begin from where we stop. The last class, we started to look at IS 12, that is income taxes. And as a quick recap, I told us that income taxes deal with a major two concepts. And that's the concept of current tax as well as that of deferred tax. And then that of current taxes is your taxable profit multiplied by the tax rate. Whereas your deferred tax is the temporary difference multiplied by the tax rate. I told you that the deferred tax will always occur as a result of temporary difference between the current amount of an asset and the tax base of the same asset or liability as it were. And I told you that the deferred tax calculation or evaluation as it were is always making use of the balance sheet approach, because majorly what will always cause a difference between what the accountant prepare, accountant of an entity prepare, and that which the IFRS prepare, the FIRS prepare, is basically because of the differences between what is recognized as capital allowance, which is also known as tax depreciation, and what the accountant, in line with IFRS, also recognize as the accounting depreciation. Usually, these are what we always give rise to, the temporary differences between those calculations by both or by those separate individuals as it were. So we're able to look at the current year tax, how to calculate it. And I told you that you are going to do adjustment to your profit before tax. And then after doing all those adjustments, whatever you have at the end of the day will become what we call taxable profit. And then you will multiply it by the tax rate, and that will give you your current year taxes. And the journal entry is simple, or the accounting statement is very simple. You just debit whatever you get, you debit your POL with what we call the income tax for the year, and then you credit your tax payable under the current liability in your statement of financial position. It's as simple as that. And so quickly we move to deferred tax tonight. How do we go about deferred taxes as it were? We have given it a whole lot of definitions and the likes. I'm very positive that between now and tomorrow, the first video will be uploaded, and then you can watch. For those who were not in that class, you can watch to familiarize yourself, and those who have forgotten the like. So deferred tax is also a simple tax for you to calculate, and the steps are just very simple. I told you we have basically 4 steps. So let's quickly look at those steps. Steps to look at, steps in determining deferred tax asset. The first one is to determine the carrying amount. We said a lot about this the last class, but let me just refresh you. Determine the tax base of the asset. That's the first step. Very, very important. Tax base of the asset. That's the first thing to determine. And then the second step is determination. Determine the carrying amount of the asset. The carrying amount. Please, it can be asset, it can be liability. In case you, let me just put it. Asset or liability. Always determine what? The tax base. Then second step is to determine the carrying amount of the asset or liability of the asset or the liability. That's that for that. The asset or liability. And then the third step is that you determine the temporary difference. How do you do that? By comparing the tax base to determine the temporary difference by comparing the tax base to the carrying amount of the asset or liability. And then the fourth step is whatever you get in this step 4, you multiply it, that is determine the deferred tax. The deferred tax, which is, whatever it is, the temporary difference that you get. This temporary difference multiplied by the tax rate. That's how to determine the deferred tax asset. Very, very simple. And I'm sure we are in order with that. Right? Quite very sure we are in order. So that is that for that. So quickly, I'm sure this is very clear. Just note this step, follow these steps, and then apologies, please. Can you still hear me?
Yes, sir.
Yes.
Are we still together? Can you still hear me, please?
Yes, sir.
Okay, thank you. So these are the basic steps to follow. Determine the tax base of the asset. Step 2, determine the current amount of the asset or liability. Step 3, determine the temporary difference by comparing the tax base to the current amount. And then step 4 is to determine the deferred tax. And that is by multiplying the tax rate with the temporary difference. Please, all that you need to know is just these 4 steps. Once you know this 4 steps, there is no deferred tax they want you to calculate that you won't be able to deal with any day, anytime, anyhow they bring it for you. It's as simple as this. However, it is important for us to also know how to identify which one will be deferred tax asset, identify which one will be deferred tax asset and deferred tax liability. Can anyone help me out? We discussed much about it the last time. How to identify the deferred tax asset and deferred tax liability. Can anyone help out? Are we still together? Can anyone help out? Okay, Moses, go ahead.
Yes, sir. Good evening, sir. I think when we talk of deferred tax asset, it is when the carrying amount is greater than the
start with the tax. Deferred tax asset.
Deferred tax asset. That is when the carrying amount is greater than the tax. The tax base is greater than the carrying amount of the asset. That is deferred tax asset. While deferred tax liability is when the carrying amount of the asset is lesser than the tax base.
Come again.
deferred tax asset is when the tax base is greater than the carrying amount of the asset. That is when the tax base is greater than the carrying amount of the asset. Oh, no, sorry. When the carrying amount of the asset is greater than the tax base, that is deferred tax asset. But when we talk of deferred tax liability, when the carrying amount of the asset is lesser than the tax base.
Okay, thank you. So let me quickly take us back for a refresher. For assets, please take note, it can be current assets or non-current assets. How do you identify deferred tax asset and deferred tax liability? Please take note of what I'm doing now. Now, when your tax base of an asset is greater than the carrying amount of the asset, it will result into deferred tax asset. Please take note of that. Take note. I'm the one begging you now. When the tax base, in other words, the carrying amount is lesser than the tax base, when the tax base is greater than the carrying amount, it will result into deferred tax asset. In other words, the carrying amount is less than the tax base. But when the tax base is lesser than the carrying amount, it will result to deferred tax liability. Please take note of this thing that I've just said. It's very important that you should know it. If you don't know this, no matter the calculation you are doing, your posting will be wrong. Let me explain it in a layman way. The tax base of an asset is the one that the tax authority have prepared, whereas the carrying amount of the asset is the one that the accountant or those that are preparing an account for an entity, that's what they have determined. In determining the carrying amount of an asset, you will have removed what we call accounting depreciation from the cost of the asset, the historical cost of the asset, for you to get the carrying amount of the asset. And for you to also determine the tax base of the asset, you will have removed the tax depreciation, otherwise known as a capital allowance, from the cost of the asset. You understand me now? Now, what you have prepared as an accountant of an entity, you have realized, you have determined the carrying amount of the asset, and then you have gotten your own carrying amount. The one that the tax authority prepare which is known as the tax base, they have also prepared their own. Now, in you preparing your own, you will have paid what is called the tax to the authority, as it were. Now, the tax authority, they prepare their own. What they have now prepared is now higher than what you have prepared. Are you following me now? It's not higher than what you have prepared. It means that you will have a claim and from the tax authority. In other words, the tax people or authority, as it were, they are the one now owing you. They are the one now doing what? Now owing you. That is how it is. But when the tax base is now lesser than the carrying amount, in other words, the carrying amount of the asset, as it were, that you have prepared is now, please just give me 1 minute. Let me plug my sister. I don't want what happened the last time to happen now. 1 minute, please. Okay, thank you so much. Sorry for that little breach. So please, like I was explaining, once the tax base is greater than the carrying amount, in other words, the carrying amount is lesser than the tax base, it means it will result into deferred tax asset. And when the tax base is lesser than the carrying amount, it means that what is it called? It will result to deferred tax liability. Please take note of what I have just said. And like I was explaining, the simple meaning is this: what the tax authority have prepared is higher than what you have prepared. You have what we call a claim from the tax authority, and that is what we usually call deductible temporary differences. Deductible temporary differences. Please take note of what I've just said. You can be asked in your exam that you should explain deductible temporary differences. It's the same thing as when the carrying amount of an asset is lesser than the tax base of the asset. In other words, the tax base is higher than the carrying amount of the asset. Please take note of what I've just said. Once the carrying amount is lesser than the tax base of the asset or the liability, when we get to liability, I will explain that. But just understand what I've just said now. This is for asset. Any question? Is it clear enough? Can I go ahead?
Yes, sir. Go ahead, sir.
Moses, please don't make mistake again. I'm begging you, please.
Thank you, sir.
All right. Now, okay, someone is raising his hand.
Sorry, sir. What's the full meaning of TL?
TL.
TL, yes. Determine the
tax rate. Tax rate. Tax rate. Then for liability now. For liability, it's just vice versa. For liability, when the tax base of a liability, tax base of liability, since we are under asset, let me just put tax base is greater than the carrying amount of the liability. This will be equal to what? Who can help me? Who can help me?
Deferred tax liability.
Tax liability.
Where the tax base of a liability is greater than the carrying amount of the liability to result to deferred tax liability. And where the tax base is lesser than the carrying amount of the liability, it will result to deferred tax asset. Please take note of these key things. These are things that they may not explain to you well, maybe when you are reading on the lines, but I want to make it in a layman way so that you will understand it. For assets, once the tax base is greater than the current amount, it will result in deferred tax liability. But it's just the opposite for liability. Once the tax base is now greater than the current amount for the liability, it will result to deferred tax liability. Is that understood? Can we go ahead, or I should explain again?
Yes, sir. You can go ahead, sir. Understood.
Thank you so much. All right. So now let's look at example. This example, very simple. The following information is available for your use to advise the board of directors at the next annual general meeting. Equipment cost is 1 million. The useful life is 5 years. And then it will be depreciated on a straight line, and it will be 200,000 naira per year. The tax depreciation, which is also known as capital allowance. I know why I'm saying this now, because some of you will get to exam, they will tell you tax depreciation. We are asking what is tax depreciation. And for some of you that are also doing FM now, I'm sure you will have been hearing something like tax depreciation, tax depreciation. Tax depreciation is something as a capital allowance. It's equal to 300,000. In year one, the tax rate is 30%. Determine the deferred tax treatment in year one. Who can quickly recap the 4 steps? The 4 steps that we have to take. Who can quickly recap it for me? Very quickly. Who is here?
Determination of the carrying amount of the asset.
Carrying amount of the asset, okay.
And the determination of the tax base of the asset.
Tax base, thank you. The third one.
Then the rate by getting the difference. We need to determine the temporary difference.
Temporary difference, TD, okay. And then
we multiply the tax rate.
Then we multiply the tax
rate by multiplying it with the tax rate.
Please help me clap for Moses. Moses, I'm giving you 2 marks. You have done well tonight. Thank you so much. So please remember what I've said. In determining your deferred tax asset or liability, it takes just 4 steps. Number 1 is, if it is an asset, begin always by identifying the nature of the item. Either it is an asset, you need to know if it's an asset or a liability. That is what will also help you to classify them as asset or liability in terms of their nature. Please take note of what I've just said. That is the first thing first. Now, for instance, this question we are looking at, this is equipment. Equipment is under what? PPE in under non-current asset. So this is an asset that we are dealing with. So take note of that. Now, we were told that the cost is 1 million. The useful life is 5 years. So following the steps that are given to you, I told you the first thing first is to determine the tax base. So you can do it vice versa. Anyhow, if you know you are very okay with it. Why I always start with the tax base for an asset is so that from what I have given to you, to be easier for you to identify and to move ahead and know exactly what to do. You are permitted to put tax base first and put carrying amount second and then get your temporary difference. You are permitted. I'm the one telling you to do it that way. You can. But if you are okay, you can as well start with the carrying amount, put the tax base by the side, get your temporary difference, and then multiply it by the tax rate. It's as simple as that. So now from this question that we are looking at, we have been told whatever it is that we need to know. So let's quickly go to the solution. The information are handy. Let's go to the solution. The first step is that we should determine the carrying. I told you we can do it vice versa. We can do temporary, tax base. We can do carrying amount, anyone. But since an asset, please, let's change it so that it will confuse us based on what I have said. So tax base is what we are determining first. And so how do we determine our tax base? I told you that the taxes of an asset is always equal to the cost minus the tax depreciation or capital allowance. So from the question that we are given to, we were told that the cost is 1 million and the tax depreciation is how much? 300,000. So therefore, what will be our year one? What will be the tax base of the asset in year one? And then what tell me? The tax base of the asset for year one will be what?
700,000.
700,000. That's what? How did you get that? That is equals to
cost minus
1
tax
million.
depreciation.
1 million minus how much is that?
300,000.
Thank you so much. Minus 300,000. Please, are we all following? Is it okay? Are we all getting it? That's our step 1.
Yes,
so
we're getting it, sir.
Thank you.
We're getting it, sir.
And then that is equals to 700,000. So let's quickly go 700,000. We have gotten this. Then step 2 is to determine our carrying amount. Carrying amount. Step 2, determine what? The carrying amount of the asset. Carrying amount of the asset. And so, carrying amount. How do we determine our carrying amount? Our carrying amount is always equals to what? Cost minus
depreciation.
Accounting. Let me use it. Accounting depreciation or accumulated depreciation. Do you understand now? So, like I was explaining also the other class, the other class, tax base is you using what we call the FIRS, Federal Inland Revenue Service, laws and rates and the likes for you to determine the base of an asset. Whereas the carrying amount of an asset is being determined by following what we call the IFRS principle according to IAS 16. It's as simple as that. I'm just going back to buttress what I've said. So what is the cost? The cost still remains 1 million naira. Remember, I told you that usually what will always cause this difference is the way an accountant of an entity will prepare their own, and the way the accountant of IFRS, Federal Revenue Service, will also prepare their own. So what is the depreciation, accounting depreciation for this particular thing that we are looking at, this example we are looking at? This is 200,000 per year. We were told that the cost is 1 million, useful life is 5 years. Remember, for you to determine depreciation is equals to the cost minus residual value divided by numbers of year if we are using straight line method, and if it is a reducing balance method, usually it will be a cost multiplied by the rate that is being given to you. Either way, you can get your depreciation. So we were told that the 5 years, this is 5 years, there is no residual value. So when we divide the 1 million by 5 years, it means we are going to get 200,000 per year. So who can tell me exactly what will be our current amount now? Are we still together?
800,000.
800,000 will be the current amount of this very particular asset. So the third step is we are to determine what our temporary difference. And how do you do it? It's just to minus the tax base minus the current amount. That will be equals to what is that? 700,000.
Negative 100,000.
Minus 800. In other words, the tax base is lesser than this is the reason why I prefer to put my tax base first, so that once I get negative, directly I know it is a liability. Do you understand it now? Do you understand why I'm doing it now? Do you understand why I'm doing it this way
Yes,
now?
sir.
So it
Yes,
is
sir.
easier for you. It's easier for you to know if it's an asset. Just do it this way. It will give you negative. But if it's a liability, you should know the vice versa will be the case. So by this now, you know that your temporary difference is 100,000, and then you determine your deferred tax. That's a step 4. And what is that? Deferred tax is the temporary difference, Abi, multiplied by
Tax
what?
rates.
The tax rate. Thank you.
So,
So that will now be what? Negative 100,000
30. Multiply by
multiplied by
30%.
0.30. That will give us 30,000. Is that also 30,000?
Yeah.
So do you see it? It's as simple as this. Negative 30,000. Did you see it now? Negative 30,000. It's as simple as that. So what is the accounting treatment for this? It's also very, very simple. So a deferred tax of 30,000 is recognized at the end of the day. What is the accounting treatment? Very simple. Accounting treatment is, what do? You, since it's a liability, you debit POL. Debit POL, and then you credit your
income tax.
You are debiting your POL already now. Deferred tax liability. You are debiting your POL deferred tax liability already here. With deferred tax liability, And then you are crediting, I will explain it all so that you understand. Then you are crediting your SOFP, that is statement of financial position. You are debiting SOFP, and that's the liability. You're debiting your current or now. How will you know if it's going to go to current or your long-term liability? It is when it is certain that you are going to pay that deferred tax within the next 1 year, you recognize it under your current liability. If you are not certain that you are certain that you will not pay it under that 1 year, you take it to your long-term liability. So credit liability in your SOFP, as simple as that. Now let me explain something here. Deferred tax liability is what we have gotten. Deferred tax liability simply means the additional payment that you are going to pay to the tax authority. Do you understand that now? So for you to increase the amount, you know that if you, for instance, if we determine our current year tax, what do? We will debit POL with current year income tax. And also we are going to have what we call income tax expense. Now that we have determined the temporary difference, we are now having what we call deferred tax liability. It means there's the amount that you are going to pay to the tax authority. So by having what we call deferred tax liability, you are increasing your indebtedness to the tax authority. That's why we are debiting P or L. Now, assuming it is deferred tax asset that we have, we are going to debit asset and we are going to credit P or L. In other words, we will reduce the amount. So deferred tax asset reduce the amount that you have to pay. Deferred tax liability increase the amount that you have to pay. It's as simple as that. Do we understand it? Are we still together?
Yes, sir.
Yes, sir.
Any questions so far? Is it clear enough? So
It's
this is
clear,
how
sir.
it's very, very simple. Now let's take a look at another example. Or this time around, I want you to be the one to help me to do this very illustration. Please make it very, very fast. Or just snap it, then you give me the solution on the WhatsApp platform so that we can continue with the lecture. Can you do it? Can you do it, or you want me to still do this one too? Please, let's speak up. You want me to do it or you will do it? Kato, Kainde, you will do it.
That accounting profit for the year.
Accounting profit for the year is 1.5 million. Yes. What happened to it?
Do I do that one? I can. I understand others, but I'm looking at accounting profit for the year. So I'm looking at where to use that.
They say require compute the current tax and deferred tax for 2025. Sally, you are raising your hand. Any issue? Sally, I will raise your hand.
Yes, sir. Good evening, sir.
Good evening.
Yes, I've been trying to join the class since my network is not allowing me. I'm just joining.
Okay. Just continue to
Yes,
follow
so I don't.
us.
Okay.
We are looking at deferred tax under the IAS 12. We have been able to look at the current year tax. And well, this class is being recorded. You can as well just watch the video after the class. But it's a very simple standard. Deferred tax, current year tax is simple. And how do you determine it? Is by multiplying the taxable profit by the tax rate. Do you understand me now? And then we have what we call the deferred tax asset. The deferred tax asset always arise as a result of differences that can occur between what an accountant have computed for the year and what the tax authority will compute for the year. And that differences is usually what we refer to as temporary differences. And so once we have that temporary differences, you multiply by the tax rate, it will give rise to what we call the deferred tax. So deferred tax arises as a result of reconciliations that can take place between the differences and by what the accountant of an entity have prepared and what the tax authority have prepared. It's as simple as that. And I told you the step to determine the current year tax is very simple. It's just to determine first of all the profit before tax for the year, and then make necessary adjustments. And once you made all those adjustments, what are the adjustments? Add back all the disallowables, and then less what we call reliefs, all the reliefs like capital allowance, and then the loss that were relieved. Once you less them, you arrive at what we call taxable profit. And once you arrive at taxable profit, multiply by the tax rate, it will become what we call the current year tax, the current tax or the current year tax for the entity. You are at the deferred tax. Just 4 steps is all that you need to follow. Number 1 is to determine the tax base of the asset. The tax base of the asset is the cost of the asset minus the capital allowance or the tax depreciation. That's step 1. Step 2 is to determine the current amount of the asset, and the current amount of the asset is always the historical cost of the asset minus the accumulated depreciation. That is what IFRS has told us under IAS 16 to do. It's as simple as that, using the cost model. And then the step 3 is to determine the temporary difference, that is the difference between the tax base and the current amount of the asset or liability. So once you're able to determine that temporary difference, you multiply by the tax rate, it will give you deferred tax asset or deferred tax liability. And how do you know if it's a deferred tax asset or deferred tax liability? When the tax base of the asset is greater than the current amount of the asset, it will result to deferred tax asset. Once the deferred tax, the tax base of an asset is greater than the current amount of an asset, it will result into what we call deferred tax asset. Whereas where the tax base of a liability is greater than the current amount of a liability, it will result to what we call deferred tax liability. Take note of that. And also, when the tax base of an asset is lesser than the current amount of an asset, it will result to deferred tax liability. When the tax base of an asset is lesser than the current amount of an asset, it will result to deferred tax liability. And when the tax base of a liability is lesser than the current amount of a liability, it will result to deferred tax asset. When the tax base of a liability is lesser than the current amount of a liability, it will result to deferred tax asset. Simple as that. These are the things that you need to know. So for the sake of those that said they are just joining, let's together look at this example again. Solution. Step 1 is that we should determine what? First step is to determine the tax base of the asset. Determine the tax base of the asset. And that is equals to, we say, cost minus the tax depreciation, which is also known as what? Who can tell me? Capital allowance. Thank you. So the tax base of the assets is what now? Who can tell me quickly?
600,000.
600,000. Let me clap for this man. I'm giving you 1 mark for that. Thank you. So that's that for that. Then step 2, we said we should determine. Step 2, determine the current
Accounting
amount of the
depreciation.
asset. Determine the current amount of the asset, and that will be equals to what? Cost minus
800.
minus accumulated
800,000.
depreciation.
That's 800.
The cost is that will be equals to what? 800,000. 800,000. And then the step 3 is to determine what? The temporary difference. Temporary difference is equals to the tax base of an asset minus the current amount of the asset, and that is equal to what?
1,000. Liability.
No, I didn't want you to say it. I wanted Sally to help me out with this because I know I've explained everything that she needs to know. 200,000 negative. That's what we've got. So, my friend Sally, this 200,000 that we got, is it a deferred tax asset or a deferred tax liability based on what I have explained?
Deferred tax liability.
Thank you so much. So please, in your exam, to always quicken and help you out, put the tax base first, put the current amount by the side, and then go ahead and do whatever it is you want to do. Now, understand this.
Sorry, sir.
You said?
Sir, please, this 600, is it 200 plus 400?
No. 600 is determined by I told you that the tax base of an asset is determined by what? The cost of the asset minus the tax depreciation, which is also known as a capital allowance. Tax depreciation is how much here in this question? 400,000. Are you seeing it? Are you seeing it? So 1 million.
I understand now. I understand.
Okay, thank you. Minus 400,000. That's what gives rise to the 600,000. So take note of that.
Okay, sir, I understand.
So now that we have gotten our temporary difference, the step 4 now is to what? Determine the deferred tax. And our deferred tax is equals to temporary difference multiplied by what? The tax rate. And that will be equals to what?
Rates. 60,000.
60,000 negative. How do we treat this? Who can tell me how we are going to treat this? Are we still together? Okay, go ahead.
Debit PRL with 60,000 and credit SU statement of financial position. Deferred tax liability.
Thank you. That's how simple it is. That's how to treat it. You debit your POL because this deferred tax liability is what? Is an amount that you are owing the tax authority. Please take note of that. Then you credit SOFP, financial position, deferred tax liability under liability. So it's as simple as this. It's not something that is difficult. However, understand that you can be given a question that they will not give you one asset like this. They can give you 10 assets with different carrying amounts. Do you understand? Once you have more than one, you don't need to be doing it one the way I'm doing it like this. All that you need to do is, if you have more than one asset, all that you need to do is just say, put it in a table, item. Simple. After item, you proceed, you go to, you can write item after item, put tax base. The next one, carrying amount. The next one, temporary difference. The next one, tax rate. And that is it. Do you understand? Then you list, if they are 10, you just list them there. And their temporary difference will be helping you to know whether they will be recognized as a deferred tax asset or deferred tax liability. Do you understand? So that is that for that. So let's quickly look at this illustration 4. Hopefully, I hope it's not something that is difficult. It's as simple as ABC. Go ahead. Moses, go ahead. Ace, go ahead.
Sorry.
Okay, good evening, sir.
Good evening.
So the previous question says compute current tax and deferred tax. The current tax, is it the previous, is it the one we did in the last class?
The way you did it the last time. Okay, I did not compute the current year tax in that question. Okay, let's go back and see now. This thing is very simple now. Now, based on what I have taught you the last class, now you can simply tell me what to do here. Quickly, under 1 minute. Oh yeah. Ace, you are the one that asked this question. Answer me. Based on the last class, we're in the last class. What do you do now? I told you to get your current year tax is very simple. You just determine what we call the taxable profit. What is your taxable profit? I told you profit before accounting profit for the year is 1,500. And since they are giving you accounting profit for the year, means that they will have added what is it called? Depreciation before determining this accounting profit for the year. I mean, they will have less depreciation before determining the accounting profit for the year. So what do? Just add back this accounting depreciation to it, and that is you will get by it. There are no, then you less what we call tax. What is it called? Tax depreciation, and then before you know it, you have gotten your current year tax. Do you understand it now? So can you quickly do it now? Very simple. Accounting profit for the year. What is it called? Hard accounting depreciation because it is disallowed. Then less capital allowance from it. Simple as ABC. That will give you what we call taxable profit. Multiply it by the tax rate. It will give you the current year tax. Do you still want me to do it? Okay, yeah, let's quickly do it.
Yes, sir.
We are here together. The tax.
I think the tax for the year is 390,000.
Okay, thank you so much. So let's check if you are correct or not. The profit for the year, profit is equals to 1.5 million. Is that also 1.5 million? And then we have depreciation for the year, accounting depreciation for the year to be 200. So you are going to add back the accounting depreciation, add accounting depreciation. How much is the accounting depreciation, please?
400,000.
Are you sure?
No, 200.
200,000.
200,000.
The answer should be 1.3.
200,000. Then you less. What are we lessing?
Capital allowance. Capital allowance. Called depreciation.
So we are going to less our capital allowance. How much is that one?
400,000.
400,000.
So to give us 1,300,000.
1,300,000.
Yes.
Okay. So if we get our 1,300,000, sorry, please. What will be our current year tax? Will be what? This is what we call taxable profit. 1.3 million. So our tax rate is what? What's our tax rate?
30%.
30%.
So we'll multiply this one by 30%, that's 0.3.
That is 390,000.
390.
So we can see that this very standard is also very, very simple. Don't let anybody tell you that these things are difficult. They are not difficult. They are very simple. And then what will be our current year tax? Our current tax will now be what?
390,000.
390,000. So it's as simple as ABC. So I'm sure by this now you can deal with deferred tax as well as current tax for the year. I told you what will be the journal entry for this. No one can help out.
Debit income statement and credit current liability.
Current liability, debit income statement. That's debit income statement. What will be your narration? Current year.
Current year tax.
Thank you so much. And then your liability will be what?
Current year tax.
And the liability under your current liability is what? Tax payable. Thank you. It's as simple as that. Thank you so much. So it's as simple as this. It's not something that is difficult. Please start reading. Start checking your books. There is nothing difficult. Wherever you face any challenge, call me. I'm available. I will attend to you. All that I need to guide you is this. It's as simple as that. Any question before we call it a day?
So it's the last class on YouTube.
It will be uploaded tonight.
It will be uploaded tonight.
Or tomorrow morning on Felele. Are we good to go? Any other question?